Welcome once again. This is Pinnacle Professional College, and today we would be talking about other theories of corporate governance. We've been looking extensively into corporate governance, and today we'll be diving deeper into it. So let's talk about other theories of corporate governance. Now, we all know that the agency theory is based on the view that the directors of a company are the agents of the company's owners, the shareholders, right? Since the directors as agents do not have the same attitudes as their principal, some measures are necessary to ensure that governance is effective. So this is where measures such as monitoring the directors and applying some control over them is important. Right? You have to monitor the directors. It's a way of ensuring that they align in terms of interests, right? And this can be done through the annual reports and external audits. Also, encouraging directors to act in the best interest of shareholders by offering them rewards, incentivizing them, incentivization. Typical example of incentive is bonus incentive schemes, basically for achieving certain targets for the company. Okay. So now let's delve into the theory. Now, the first theory we are going to talk about is the transaction cost theory. So the transaction cost theory attempts to explain companies not just as economic units, but as organizations that consist of people. So here we are not seeing an organization as an economic unit. When we say an economic unit, just as an entity that exists to just make money, but as an organization that consists of people with different perspectives and views. A large part of the theory is concerned with what makes an organization grow to the size that it achieves. How many operations does it undertake in-house, and how much does it buy in from external suppliers? Right, so this is basically comparing, should we do stuff internally or outsource or buy it from external suppliers? Logically, a firm's decision about whether to arrange transactions in the open market or whether to do the work in-house depends on which is cheaper, right? When a firm does work in-house, it needs a management structure and a hierarchy of authority. It's very, very important. So there are situations where organizations must make decisions. And these decisions would involve whether the organization will undertake the operation in-house or will subcontract it to an external supplier. According to the theory of transaction cost economics, the structure of a firm and the relationship between the owners of a firm and its management depends on the extent to which transactions are performed internally. That's a very, very interesting theory, right? It's basically saying that the relationship that the owners have with management, or the relationship between owners and management, depends on whether transactions are performed internally. If transactions are performed externally, and then that's a different case. From a governance perspective, traditional economic theory is based on the assumption that all behavior is rational and that profit maximization is the rational objective of all businesses. That's from a governance perspective. But from a transaction cost economics perspective, it changes this assumption. And how does it change this assumption? It makes room for human behavior and the fact that individuals do not always act rationally. If you've lived in this world for some time, you would know that human beings do not always act rationally. So the transaction cost theory is based on two assumptions about behavior. Number one is what we call bounded rationality. Bounded rationality, not just rationality. Rationality that is bounded. What does this mean? Human beings act rationally, but only within certain limits of understanding. This means, for example, that managers of a company will in theory act rationally in seeking to maximize the value of the company, but their bounded rationality might make them act differently. In essence, what we are saying here is that there are limits to rational thinking. So number one is what? We are talking about human behavior here. Number one is what? Bounded rationality. Number two is what we call opportunism. Opportunism. Individuals act in a self-interested way and with guile. In other words, people will not always be honest and truthful about their intentions. People will be opportunistic. Opportunism is an effort to realize individual gains through a lack of honesty in transactions. Trying to be opportunistic, sneaky. This is human behavior. Human beings try to take advantage of an opportunity at the expense of another person. So these are all theories of corporate governance. So number one is what? The transaction cost theory. Number two is what we call the stewardship theory. The stewardship theory. Now, what is the stewardship theory? In the stewardship theory of corporate governance, it is recognized that the directors of a company have a stewardship role. And what does this mean? They are basically assigned to look after the assets of the company and manage them on behalf of shareholders. So as stewards of the company, they are basically agents and they are accountable to the shareholders. And how are they accountable? Through the annual reports, right? They present annual reports to the shareholders. So number one, transaction cost theory. Number two is the stewardship theory. Number three is what we call the resource dependency theory. Resource dependency theory looks at how the resources of an organization affect governance and behavior. The basic arguments of resource dependence theory can be summarized as follows. Now, look at these steps or this line of thinking very carefully. Organizations depend on resources. And resources are a basis of power. Whoever has the resources has power, right? Legally independent organizations may therefore depend on other organizations for the resources that they need. Power and dependence on resources are directly linked. So when we talk about the resource dependency theory, we are looking at how the resources of an organization affect governance and behavior, right? How do resources affect governance? How does it affect the behavior of the organization? If you depend on resources, how does it affect your behavior and how does it affect your governance structure in that sense? Because resources, as I already explained, are a basis of power. They are a basis of power. Okay, so this is where we'll bring to today's lecture to an end. If you haven't subscribed to this channel, please do so. Thank you for listening. Please share this video with other people so that they can gain access. Thank you and have a good day. Bye-bye.